This week on Wealth Track, a rare interview with noted value investor Tom Russo on why the ability to say no and the capacity to suffer are key to investment success. Next on Consuelo Mack Wealth Track. One of your major holdings is Nestle,
Yes.
and Nestle has just hired a new CEO, Mark Schneider,
Yes.
who has no background whatsoever in food and beverage, and he's from a healthcare company or something,
Yes,
right?
exactly, presented.
Nestle was targeted by Dan Loeb, an
Yes.
activist investor.
Yeah.
I mean, Nestle's shaking things up, is being shaken up.
Yes, yeah.
What's your view of Nestle?
Well, you know, the background, well, it's a fabulous enterprise.
Yep.
It has global reach. It's 150 years old. It has 125 markets. You think about markets, whether it's Nigeria, whether it's Kenya or India, their products are literally the staples of life. And companies as strong and as deep in domain expertise in food, beverage, that exists in Nestle are going to be required for us to feed the world. So no question they have an important role to play in the future. The question is how much they can afford to invest today at the expense of current results for future returns.
And they're feeling the heat.
They feel the heat today because someone's come along and said, enough today. We need more today and less jam tomorrow. You know, it's about jam today or jam tomorrow, and there's an IRR that's built into the mix. And Nestle has always favored gold-plated spending for the future returns. And you know, if you look back since we've owned it in 1987, it's probably compounded at 14% a year total return, and it's done so because they've been willing to take those big bets, and they've won the results that have come from it.
Now
today,
what?
Today there's pressure on the demands for returns up front. I mean, they've already announced a $20 billion share repurchase program that they actually commenced before the publication by Third Point of their stake.
Capacity to reinvest is one of the hallmarks that you said that you look for in a company. We just talked about that at Nestle. And also the other one is the capacity to suffer, which means that you reinvest and you suffer short term. You know, your results aren't as great because you're putting the cash basically back into the company or into businesses. So one of the examples of the capacity to suffer is Philip Morris, and that's one of the ones in the capacity to reinvest. Can you tell us what the story is with Philip Morris and why that is a core part of your portfolio?
I'd be glad to. And what's really interesting about the capacity for management to suffer as it relates to the reinvestment process. First, the most important thing, you have to have the capacity to reinvest. The beauty about the businesses that we try to find have open-ended reinvestment opportunities geographically. And with population, 96% of the world lives away from the US, you'd like to increase your odds of success by finding markets beyond our shores.
Right.
That's really the driver. And Philip Morris is the largest premium cigarette manufacturer in the world. So they have plenty of space in which to invest worldwide. However, the historic product on which they have relied has harmful side effects. They want to stay in business, and they resolved 4 years ago that they would invest a substantial amount of their then abundant profits to help them transition from a business that was going to, over time, die into one that they could transition to. So they committed to spend $500 million a year to come up with products that were non-combusted.
Right, and they're called RRPs, reduced risk products.
Yeah, and the beauty of what they embarked upon is that others didn't follow. I mean, they basically spent the money, and you understand what it means is that their reported profit would show $500 million less than it could have had they not been investing purely on the science. Now, what did they come up with? They came up with 1.8 million pages of clinical data that they presented to the FDA to get approval by the FDA, ideally, that would recognize that this product has the substantial equivalency of smoking cigarettes without the harmful effects.
And it's IQOS, IQOS.
Yeah.
And it's not a vapor cigarette. It's not right.
No, and that's one of the side issues with the capacity to suffer. It applies to the burden of doing something, but it equally applies to management's willingness not to do something. And that's where it gets really interesting, because Wall Street clamored for Philip Morris to get on the e-cigarette train, and they refused to commit the kind of capital because they felt it was bad technology. And the reason is that if you're a smoker, when you initiate smoking, you end up at something like 19 milligrams of nicotine within the first minute of your smoking. E-cigarettes, by contrast, would deliver 2. And so if you think about what a consumer wants and what they can deliver, and they can't deliver more because of battery technology and the way that the aerosol goblets are created and go through the throat and all the rest. There are reasons why it's capacity constrained. And for that reason, Philip Morris had the capacity to step away and say, no, it's not. It won't be our capital commitment to try to improve that unimprovable basis.
Right.
But they did go off into a different venture, and that's turned out to have some extraordinary receptivity. In the markets in which they first launched this product called IQOS in Japan, they have as much as 30% market share of what was formerly the cigarette market converted to the IQOS.